The rise and fall of LUNA and UST, and some of the darkest days we have ever seen in this cryptocurrency space. I have a brilliant fundamental guide from Haseeb Qureshi breaking it down perfectly of exactly what happened and where we can learn from the mistakes again in the future. Plus, our friend Arthur Hayes is back once again. The oracle of the crypto and market space gives us his prediction and the exact dollar amount where he is buying Bitcoin and Ethereum in the latter half of 2022. And if this man is right, which he often is, I can tell you right now there is still some more downside to come. So have that fiat dry power allocated, because there is some cheap BTC and Ethereum to pick up in the very near future. Stick around as I dive right in. Welcome. Yes, a lot to absorb in this UTG episode. G'day, I am Tex from unitytradinggroup.com. Hit that subscribe button, hit that notification icon so you can get updates every time that we release serious alpha like this from Haseeb Qureshi. He's an investor in Metastable, Airbnb, and Earn.com, and he's written this really brilliant and quite a condensed, quick read on exactly what happened, the rise and fall of UST, LUNA, and Terra. I will put the links in the show notes below, but I will just give you sort of a brief overview of exactly what happened and where it went wrong, and you can read the guide for yourself. So he sort of goes through and he talks about how Do Kwon and Daniel Shin got together to form Terraform Labs, both coming from an e-commerce background in Korea that mostly just facilitated e-commerce, like real-time payments. And then Do Kwon came in and saw the popularity of the DeFi ecosystem and said, well, why don't we expand the Terra blockchain, which they had created after forming their own e-commerce platforms in the early parts of the 2000s, now coming into 2018 where they created Terra and said, well, why don't we expand the Terra blockchain to support smart contracts? They had seen the massive increase in the interest in DeFi, and they could create a native DeFi ecosystem to increase adoption of Terra stablecoins, which was the native Terra or the native stablecoin of their Terra ecosystem centered around UST, which was its USD pegged stablecoin. So of course you've heard of PAX, which is paired to gold. You've got USDT, which is Tether paired to US dollars. So they said, well, why don't we just create our own stablecoin for this network, call it UST, and we'll peg it to the USD, which became their peg stablecoin. So until then, the largest stablecoin on the Terra network was a coin called KRT, which was paired to the Korean won. So they expanded it, paired it with the largest dollar in existence, and the Terra ecosystem absolutely exploded. In 2018, they were looking at 0 transactions, a couple 100,000, and then over the space of a couple of years to its peak before the crash, they had facilitated almost 800,000 total transactions on the Terra network. So Terra exploded in growth. It went from 63% to $91 in the space of a year. That's 145x over the space of 12 months. So at the beginning of March 2022, Terra had flipped Solana to become the most valuable alternative L1 behind Ethereum. Let that sink in. The most valuable alternative layer 1 behind Ethereum. Incredible growth for these guys. So they had some investment from Dragonfly, and they created what was called Anchor, which was at the center of the meteoric growth was Anchor, and that was the leading protocol on Terra at the time, built by Terraform Labs. So it was a money market that accepted UST and yield generating assets, which were generally liquid staking derivatives like Steth, for example. And because these staking derivatives passively generated a yield, this yield was captured by the protocol and used to subsidize the prevailing interest rate paid to depositors. Now, this is kind of where it all went wrong. Anchor was really the center of the issue for why all of this started to unravel very, very quickly. Hold tight as I dive into this a little bit more. So Anchor, and the most controversial part of this is that the protocol decided on a fixed target yield for people who deposited onto the network. So rather than paying the market rate, which at the time was a lot lower than 20%, they said, we're going to give you a fixed interest rate. If you put money onto this network, we're going to pay you a 20% interest yield over the network average at the time. So to achieve this, Anchor contributed extra payments from an on-chain reserve of UST, which was capitalized by Terraform Labs. So they were pumping their own money into this to keep this afloat, basically. So in the early days of Anchor, this was mostly sustainable because the prevailing interest rate in DeFi was high. There was a lot of interest in DeFi at the time. They were getting a massive amount of people onto the network, and it was subsidizing the interest rates that they were giving to people on the network. But as a lot of DeFi interest dwindled over the summer, they refused to change the payment or interest rates that they were giving out to people on the network. So that made 20% guaranteed yield if you put money on the network, and the industry average at that time, now after the interest was lost, was 2%. So as we go through and we talk about this, it became Anchor. It made Anchor one of the most popular protocols on the network, and interest absolutely exploded. People were going, well, why would I pay and get 2% over here when I can get 20% from Anchor on this network? So interest absolutely exploded on this. So deposits on Anchor ballooned, going out of lockstep with Borrow. So it eventually made Anchor the single largest lending protocol by total value locked in all of DeFi. Incredible growth from these guys. So what happened was that more and more UST began to get minted, only to be deposited into Anchor for the UST yield. So at its height, Anchor held more than $14 billion in UST and became the sink for almost all of the UST in existence. It single-handedly made UST the third largest stablecoin in the world. So people would go and pay USD for UST, put it onto the Anchor network, and would get 20% yield for doing that. So they took the USD, they gave you UST, and you put it on their network to get interest. So like when a bank pays you out interest, these guys were paying out interest, but it was 20% when the industry average was 2%. So why did they do this? And was it sustainable? Well, the short answer is it absolutely was not sustainable long term for the growth. So what happened was that a 20% yield on $10 billion of UST was around $2 billion a year in interest payments they had to give out to people on the network because they had this fixed interest rate on there. But what happened was, as the UST deposits grew, the yield reserve was rapidly draining. So what does that mean? That means that they were paying basically more to acquire a customer than what that customer was paying them. So say, for example, they were paying $100, let's say, on average. This is just a figure. They were paying, the example is, they pay $100 to acquire someone to the network, but that person was really only generating $50 for them and their network. So how do you sustain that growth long term? And the reason why they did this, despite everyone saying it was fundamentally flawed, was that they were looking for long-term growth where they would get as many people onto the network as possible. There were a lot of people coming to build on the Terra platform. There was all this interest and people growing and things coming onto the network that they were just like, listen, we're happy to fund this at our loss for a period of time just to acquire people onto the network. So in the face of dwindling on-chain reserves, Do Kwon was forcefully swift to recapitalize the reserve with $450 million in UST. So you can see here the growth rate of UST was 63% in quarter one, whereas DAI and USDT, being Tether, were growing at 2 and 5% respectively. So they had a supply increase of 6.3 billion as opposed to 200 million and 4 billion respectively for DAI and USDT. So why would they do this? Why wouldn't they just stop it? Well, the argument behind this was a simple one. Anchor was essential to the broader adoption of Terra and its stablecoin UST. The reflexivity of UST alongside LUNA price attracted new developers and projects onto Terra, reinforcing the cycle of growth. And the yield, as it was argued, was simply a customer acquisition cost that it had to be paid until UST became the most dominant stablecoin in crypto. So ultimately, you can see that it was a very brilliant idea. We will fund the growth of this network up until a point to acquire new customers for the long-term growth of the network. It's very much akin to what WeWork did before their IPO. They were making $1.3 billion a year from people being inside their WeWork offices and paying to be a part of their memberships, but they were spending $1.4 billion a year in acquiring new buildings, advertising, just to try and get people on board. You can see that it doesn't work long-term. You may be able to do that with allocation reserves for a short period of time, but ultimately when you burn through all the money that you're making, where does this new money come from? You've got to have outside capital, you've got to have outside investors. Ultimately it just dries up. So you've got to stabilize your assets and your reserves to stasis. You can't have you can't have your liabilities outweigh your assets or your reserves of capital. It just doesn't work. So Algod was actually one person on Twitter which is a very well-known account, Algod Trading, and he said that when LUNA breaks all-time highs, I'll short it with size. It's a big-ass Ponzi. Pretty sure venture capitalists will also hedge their investments on perps. Yeah, but you're basically saying that VCs would hedge their investments on a short if things started to go south. They would short LUNA or short US, whatever. They would short the network. And this is where people were saying that, Do Kwon maybe got a little bit of what he was, he got a bit of what was coming to him. I think ultimately when you look back at it, I wouldn't agree with that, but his arrogance and how he treated people and, he was very arrogant. It was very, very arrogant. And you can see here as you're reading it, as I'm talking about it, talking about people being retarded for stating the obvious that this was not a cycle that could continue. And calling people poor and stuff. I think he got caught up in the growth, as I'm sure a lot of people would, but certainly it was not the right attitude to have. So this Terra community was now dependent on Anchor, and unwinding it wasn't an option. And the market capitalization of LUNA, which essentially backed UST, was twice the value of the UST supply. So ultimately it was argued that UST was over collateralized even at this level of growth. So with this setup, let's understand a little bit more what this means. So it's essential to understand that the second aspect of UST on how it was created and redeemed. So you can think of Terra as the central bank. It had liabilities in the form of UST, and it had assets in the form of LUNA, which was the native token of its blockchain. This central bank had a single mandate or requirement: keep UST stable and trading at $1. And it did this by essentially market making UST. It would always trade $1 of UST for $1 worth of LUNA, whose price it monitored using an on-chain oracle. So you can see there, you needed to keep your cash assets and your liabilities at stasis. Your liabilities could not outweigh your cash assets, and that was what was happening very, very quick. You were going into negative territory very, very quick, all in the hopes of acquiring new customers or new growth on the network. So what happened was, in order to keep this growing, it established what was called the LFG fund, which was the LUNA Foundation Guard, to bolster its USD peg, was to keep things stable, so it was money coming in. This is what I said about with WeWork beforehand. It needed new VC interest, it needed new money into it, so it could balance out its books, essentially. It could spend more to acquire more customers, but it had to spend more money ultimately to do this, but it had to get lifetime value of that customer that was less than its acquisition cost. So it raised $1 billion, which was led by Jump Capital and Three Arrows, to establish a Bitcoin reserve to diversify the backing of UST away from pure reliance on LUNA. I think this is where things went wrong as well for these guys. So it was in addition to its initial funding round of 72 million LUNA, worth more than $5 billion at the time. So what happened was that the LFG fund purchased more than around $3 billion of BTC, with the goal of buying up to 10 billion BTC to become the single largest holder of BTC in the world, with the aim of backstopping the UST reserve. So one thing that I guess is fundamentally flawed from this, and we look to Ray Dalio for this, Bridgewater Associates, one of the most successful investors of all time, he talks about having a diversified portfolio of assets. So they've now got LUNA as let's say a hedge, or to stop the UST tanking, and then they bought Bitcoin again to top up those reserves. What Ray Dalio talks about is having a diverse portfolio asset allocation, that if one tanks, one can remain stable or increase to balance out your books. They've now got two assets pegged to one space, being the cryptocurrency space, which is very volatile. And I guess their thought was that we'll just buy as much as we possibly can, and we can control a lot of things happening on the network and the space. But this is where things began to go really, really badly wrong. So the reserve was now composed of massive quantities of LUNA as well as their BTC reserves, and the Terra community had a lot of confidence that its central bank was now so deep pocketed that it could not be broken. But in early Q2, stoked by fears of inflation, risk assets and crypto markets began to sell off. We have not seen the decoupling from the traditional markets as of yet, and the ratio of LUNA to UST market cap really quickly declined. So what happened is on the 9th of May, as we saw, in response to a large macro sell-off, a few whales started to pull their positions from Anchor and dumped their UST through Curve, which was the largest on-chain DEX for UST. The size of that was several $100 million in quick succession, and it destabilized the peg of UST. So what happened was that this stablecoin was no longer stable, and this incited a huge panic on the network. So more Anchor users saw all of this money being pulled from the network and said, shit, we need to pull off this market as well. So what happened is that they were redeeming LUNA and selling their LUNA for cash. So they were selling their LUNA, they were getting their LUNA back, and they were selling that for cash so they could stabilize their dollar amount. They didn't want LUNA to start declining in value and all their money going through it. So what happened was there was a massive sell-off on LUNA, and people were pulling out of Anchor, they were putting it in USD and selling all their LUNA. So what happened is that the LUNA capitalization slid from 22 billion and halved to 11 billion in the span of mere hours. So what happens? 50% of its market cap happened to decline in a few hours. Massive sell-offs. So USDT was now suddenly under collateralized. They didn't have the collateral there to bet against people selling off the market to stabilize the price of UST. It was now tipped to one side, and they could not have the reserves there to stabilize it back, because they had to buy the UST back from the market to stabilize it at $1. It was now depegged. And you can see here, we went from a stabilization of 0%, which is a stable curve, down to 50%. So it was worth half the value. And this is meant to be a stable coin. Crazy sell-offs. So the markets reacted violently. Anchor depositors scrambled for the exits before UST and Anchor completely combusted. A full-on bank run ensued. Everyone was pulling their money off the network, and this rush of selling caused a violent depegging and aggressively drove down the price of UST. So the LNG fund, which had almost $3 billion in BTC, desperately was trying to buy back the UST from the market to stabilize the currency. So what happened was that people on the network saw them transferring $1.5 billion in BTC holdings to Binance, and this is when I alerted our community inside Discord and said, yo, they're putting all this money back into the market, into these OTC markets, which makes me think there's going to be a huge sell-off and they would potentially buy it back down lower. But what really was happening is they were going to load up the BTC onto the network, to dump it, to pull UST, to buy US, to pull their, they were going to, let me say this again, they were going to sell their Bitcoin, they were going to acquire USD and then buy UST to try and stabilize the network, which ultimately caused this huge sell-off in Bitcoin, because they had 80,000 Bitcoin in their reserves, almost 83,000 Bitcoins in their reserve, worth almost $3 billion. So they had $1.4 billion, which they put onto the market. The entire market tanked, and everyone was pulling out of Bitcoin because they thought these guys were going to sell their billions in Bitcoin and tank the market. And it all just was this death spiral. It all happened at once, that everything started tanking at once. And as it says here, in the end, BTC was no diversification at all. And as many had warned, the correlation of crypto assets in times of panic had gone to 1, and the slump in BTC caused LUNA to decline even further. So they had two assets pegged to the same market, declining rapidly at the same time. They were losing billions a minute, billions an hour. It was horrendous for these guys and horrendous for the market, and more horrendous for people that had bought LUNA, put their life savings into LUNA, thinking it was going to 5 digits. It wasn't. So it was a really bad situation, So the USD peg finally fell further and further alongside the LUNA price, and it all just became a huge issue. So what happened was that the network was allowing, they were allowing a mint of around $290 million a day in LUNA could be minted and bought off the network. They would take the USDT, people would get the USD, people would get their LUNA back. But in an attempt to clear the backlog, the validators voted to release this cap and mint faster. So now they were putting more and more LUNA onto the network. And we know that scarcity creates price inflation. We got 20 million Bitcoin. If there was 500 million Bitcoin, it would be worth nowhere near as much as what it was. So you're putting more and more into the market. It's ultimately going to decline the price of the coin because there's just so much of it in existence. It doesn't make it scarce or valuable to hold it. And what happened was they went from 343 million Bitcoin, 343 million LUNA in circulation on the 5th of May to around 6.5 trillion in the market by May 12th. And that was 18,000 times more well, 18,000 times expansion. So from May 12th, LUNA was delisted from all major exchanges, having dropped from $60 to less than a tenth of a penny, and the Terra blockchain was halted as the cost of the governance attack had dropped so low that for a few $1,000,000, anyone could take over the network and wreak havoc. So it was up for grabs. It was an absolute mess. Terra had completely imploded and it was over. So Terra's now in the process of trying to reconstitute itself, but the collapse of Terra completely crashed the crypto market. Bitcoin dropped 20%, and most altcoins went down 50% or more over the course of a single chaotic week. Tens of billions of dollars in paper wealth was vaporized. Untold numbers of people lost life savings. Some of the stories that I read online really broke my heart, and it was a really hard thing to read that I just had to stop. It was horrendous, and I feel so bad for those people. And for you, if you're watching this, reach out to me. Let's jump on a Zoom. Let's see what we can do to help you out, and let's make sure that you're prepared for this in the future. It was a really terrible time. So the wind down of Terra was unnecessarily destructive. Adding to rumors, LFG still holds over $1 billion in Bitcoin that was not yet spent, and still allowed LUNA to go into hyperinflation by minting more and more and more, hurting both LUNA holders and UST holders. Terra, at the end of the day, is still a layer 1 blockchain with a burgeoning... Why can't I say that? As pure blockchain, it had an underlying enterprise value, but after the UST collapsed, the system was suddenly saddled with enormous amounts of bad debt. And when a central bank's liabilities exceed its assets, there's only one responsible thing to do: default on the debt and negotiate with the creditors. So if it was all paused and Terra negotiated a repayment plan for UST holders, which is maybe looking now through an airdrop, people would think, there would be some sort of compensation for their holdings, but instead they did nothing at the time. Do Kwon is now coming out talking about certain things that can be done to stabilize UST, maybe looking at a bit of a buyback, doing airdrops. He's gone through, and you can read this here at stablecoin if you want to learn more about it. It was a really horrible time. But, the worst part is that people were warning them about the issues here on the network, and they chose to ignore it. You had some of the smartest people in this space saying, hey, this is a pretty bad thing that you're doing here. I understand where you're coming from, but you need to look at a different strategy here. And they bashed it and said, you're retarded. That's never going to happen. We're too big. So the lesson here is that never think that you're too big to fall from grace, because this is a great lesson for that. So it's very important to always keep your ear to the ground with projects like this and understand when you start to see things like that come from a founder. It's like when you're looking into an NFT project and they dox founders. If I saw a founder of an NFT project or some sort of crypto project talking in the way I saw Do Kwon talking to people, I would start to get concerned about things. And that's why I said to the guys in the Discord, when I saw that $1.4 billion going to Binance, I was starting to get concerned that there was going to be a major sell-off, and I was out of the market. And I think a lot of our guys did as well. So what Arthur Hayes talks about, and this is that there's a fundamental issue with the class of stablecoins that requires a willing bank to hold the fiat assets to back the token. So fiat-backed stablecoins want to use the storage facilities of banks, but pay them nothing for it. So this is where we talk about UST, PAX, and a few other things like that. So that to me is a strategy that at scale will not survive. A few $1 billion isn't going to cause a stink, but expecting commercial banks to allow the holdings of fiat-backed stablecoins to reach into the $1 trillion is pure folly. So what he's saying is that fiat-backed stablecoins will not be the payment solution that powers Web3 or a truly decentralized global economy. They will not be allowed to grow big enough to properly service the world of internet-connected entities that require fast, cheap, and digital payments. We saw this in the incongruity in action when the Federal Reserve prohibited Silvergate Bank from being the warehouse of Facebook's deemed stablecoin. So had Dime launched, it instantaneously would have been one of the largest circulating global currencies thanks to its user base. Excuse me. It would have competed directly with various banking retail-enabled fiat currencies, and that was not allowed to happen. So this fundamental issue was not lost on the crypto industry. The next iteration of stablecoins was a series of projects that over-collateralized major cryptos in order to peg fiat value. So he starts now talking about DAI. He starts talking about the peg deviation of that and why that works and why it doesn't work, UST peg deviation. So again, he's talking about why stablecoins are not the ideal outcome or the ideal source moving forward for a lot of projects, and especially Web3. So the moment you have all been waiting for. What is Arthur Hayes, the co-founder of BitMEX, saying that the price will get to where he is a buyer? Drum roll. Well, it's a lot lower than where we are now at $2,032 Ethereum and $30,000 Bitcoin. The price that he is looking at, and he talks about Bitcoin-backed stablecoins and how they're fundamentally flawed as well. So, will Terra survive? He doesn't believe, he believes there's a lot left to do for Terra to survive, and he doesn't know the answer to that. But what he's saying is that after everything that's happened in everything that's happened in this market yet, he said, Red Rover, this meltdown ain't over. So he said, during a proper meltdown, the market seeks out those indiscriminate sellers and forces their hands. This week's plunge was accentuated by the forced selling of all the Luna Foundation Bitcoin in order to defend the UST peg. As always, they still failed to defend the peg. That's how all pegs fail in the face of entropy of the universe. I dutifully sold my Bitcoin at 30k and ETH 2,500 June puts. I mainly trade because I enjoy it. I made no alterations to my structurally long cryptocurrency positions, which are Bitcoin and Ethereum, mind you, even though in fiat terms they are losing value. So he's talking about holding on to his long-term crypto allocations because he sees long-term value. He's got a trading account, he's got an investing account. So while he didn't expect the markets to trade through so quickly, he is expected, on the back of the Fed rate hikes, he doesn't believe that the market can continue to handle rising nominal rates. So where he is now seeing things, he is looking to be a buyer at 20,000 Bitcoin and $1,300 Ethereum. These levels roughly correspond to the all-time highs of each asset during the 2017-18 bull market. He said the crypto markets must be allowed time to heal after the bloodletting concludes. Therefore, it's asinine to attempt to fathom legitimate price targets, but I shall say this, given my macro view about the inevitability of more money being printed, I will close my eyes and trust the Lord. We know not who amongst us has cavorted with the devil, but proclaimed fealty to the Lord. Therefore, steal yourself away from the buy and sell buttons and let the dust settle. All will be made clear to the faithful in due course. And my cough, and that is a very good way to sum this up. At the end of the day, trust those who are saying to you, rather than bashing those who are giving you suggestions on where you may be going wrong in the market. If we've learned anything from this, it's that we don't play with more than we can afford to lose. We don't put all of our allocation or funds into a single entity. We have a diversified portfolio and we remain rational at all times in this market. And as Arthur Hayes said, steal yourself away from the buy and sell buttons. You have a trading account, you have an investing account. This one remains stable, this one you play with. This one should be not more than you can afford to lose. This one should definitely not be more than you can afford to lose. Emotionally, it's the hardest thing in this market is to remain rational when things like this are happening. But if you just peel back the layers a little bit, remove your emotions from the trade and do a little bit of digging, which you can find a lot of the time through Twitter, as much as I hate it, around 85% of all cryptocurrency holders are on Twitter, myself included. It's a great way to get an ear to the market and to understand what's happening in this space. So it's a very, very sad time for a lot of people. One that I certainly hope we will never see again, but absolutely know that we will. And I hope you're okay. I really mean that. I hope you're okay after all of this, and let's learn from this and hope that it doesn't happen again. And we take it as it comes. And yeah, not a good time. But if we can find that $20,000 and $1,300 Ethereum level, had that fiat dry powder deployed and ready to bang onto the markets, because long term it could be the single best decision that you ever make. So step away, regain yourself. And I'll see you soon. Take care.